Something that we've already done in the public space. We've democratized our research, certainly. We are opening up innovation in the public equity markets originally for a client base and educating them about that innovation. VC was a natural extension for us, and we have an unbelievable partner in Titan, because they ran with this ball when we came to them and we were talking about we need to do this a little differently. We can't do this the way traditional venture capital has. Our clients keep coming to us and telling us they're not accredited. They don't meet the asset threshold or the income threshold. And they want to know why they can't have access and could we help them? And so we started looking around for a vehicle to do this. And we found an interval fund. It's a 40 Act fund, which is SEC related. All of our funds are. And because we are not going to charge a carry, we are allowed to let both accredited and unaccredited investors access to private companies.
What opening access means to us is asset classes, types of products historically only available to institutions and high net worth individuals can be available to non-high net worth individuals, so retail investors. And that means a few things, right? Tangibly reducing the level of minimums associated with getting into some of these products. Navigating the regulatory landscape around accreditation. For example, I know a lot of people that make over the 200K annual income that are actually not great investors and have access to startups and have not done very well. And I know a lot of engineers, consultants, folks that are not quite accredited that are actually quite savvy. So I think a lot of the accreditation rules will evolve over time. But insofar as they exist for quite some time, I think Cathie touched on, we've landed on a novel concept that allows retail investors to get access to alternatives like venture in a relatively liquid way compared to the typical private venture world. The other thing I'd say about democratization is the educational component. This interval fund concept has actually been around for decades. The reason not many people have leveraged it to be able to make products accessible to retail because it's really confusing. From repurchase and redemption windows to even the fee structure, which I'm sure we'll get into, quite clunky and confusing on antiquated platforms, even some of the largest brokerages. So a lot of the products that we're talking about democratizing and bringing retail access to, the distribution platform will need to be geared and built almost in a bespoke way so that people know what are they getting into? Is this suitable for me? Why or why not? Then post the initial investment experience, how can I get to know the companies? It's not a transaction, but it's a relationship with Cathie and their team and taking the investor along for the ride and understanding the thesis and the research as opposed to a point in time transaction. I think where it touches reality is there's a regulatory landscape, there's an operational landscape, there's intermediaries. You have to understand what's allowed, what's not allowed, what's right for investors, what's not right, and be able to navigate that.
I think many people are very surprised at the minimum. Five and family offices cannot get access to the venture firms and their companies the way we are beginning to. And one of the reasons for that, the reasons this is happening, Clay touched on it a bit. We're out there educating the public on these new companies. We're raising their visibility in the marketplace and letting people know how exciting these new ideas are. And that's good for VCs. Another very good thing for these companies is it helps with talent acquisition. If you raise the profile of a company and it seems very exciting, then more people are probably going to be interested in working for it.
Just returning to the perspective of maybe the retail investor, right? So investing $500, getting access, there's also a pretty thin line between access and fiduciary responsibility, right? So how do you sort of think about balancing this access for people to be able to get into VC funds and then also what most investors are seeking, which is returns? How do you sort of think of explaining sort of the return structure to the average retail investor in that regard?
The return profile, again, this is similar to our public funds, but the return expectation is higher. We have a 5-year investment time horizon generally. I shouldn't say generally, always 5 years plus. The return expectation is some
In mind, you can get into hairy territory. And so that's how we approach it.
Our research is the filter. Really do believe that we have the best research on innovation in the financial services industry. Why? Because we've dedicated ourselves to innovation in both the public and the private markets. And now we can take companies from early stage to mega cap, which we think is going to be a real service to our clients, but also to the companies.
A quick question about sort of the fee structure, and then I want to dive a little bit more into the thematics around innovation. So with things like VC, as we sort of talked about and hit on, there are much longer holding periods, usually with returns not being realized for years until the company ends up going public usually. How do you sort of make sure that investors understand that? And what is the thinking behind the fee structure, which I'll read it out, a 2.75% management fee, which you do state is better than the normal 2 and 20.
So our fee structure, the 2.75% is the relevant number against the 2 and 20. Those other fees, venture capital charges as well. They're embedded. Let's compare the 2.75%, where you have the low minimum and you have liquidity, against the 2 and 20. If you were to compare a fund with our fee structure versus a 2 and 20, and you kept your money in each fund, what you would see over a 5 to 10 year period is that the venture capital fund, and these would be the top tier, where their multiple of invested capital is more like 4.5 times, that the venture capital fees over that time span would be 40% higher than our fees. So we do think we're providing a service here in that we're comparing against venture capital, not against ETFs, and we're allowing venture access to private companies that just did not exist before, with a low minimum and with liquidity as well.
We run some math internally as well. And I think even if you were to just assume, the like for like additional expenses of like a traditional VC fund, assume it wasn't equivalent to the whole delta between the management fee and the expense ratio. So if you just take the fully loaded expense ratio ceiling of 4.22%, and like Cathie said, I think it's a 3x over 10 years. So roughly like 11, 12% IRR, you'd need to deliver to basic through the ARK Venture Fund to have it be a better deal for the investor than a 2 and 20 fund. So a 3x over 10 years, it's roughly 11% IRR. And I think over the last 10 years, the median VC IRR has been closer to 15, 16%. What you need to believe based on the data, obviously past returns are not illustrative of future. And I'm sure the last decade of returns, the future forward expected returns are going to look a little bit lower for a variety of reasons. But even if you handicap that, what you need to believe is that ARK can be an above median VC firm over the next 10 years for the fees to work out better than typical.
When you think about how innovation is traditionally funded in the VC space, the playing field is pretty unequal, right? Internationally, women historically get much less funding, people of color get much less funding. So how are you all thinking about that?
One of the reasons I've been drawn to innovation is actually a great leveler. We have never seen the amount of innovation that is taking place now. There's an absolute explosion of it. The seeds for all of it were planted in the 20 years that ended in the tech and telecom bubble, but the technologies weren't ready for what we're talking about now. AI breakthroughs really didn't start happening until 2012, well after 2000. And even cloud computing didn't happen until AWS, Amazon Web Services, in 2006. We're seeing 5 major innovation platforms: genomic sequencing, robotics, energy storage, artificial intelligence, and blockchain technology. They involve 14 different technologies, and we believe they're moving into exponential growth trajectory. So what we say to our companies and to our clients is get on the right side of change. There is so much happening now. It is the great leveler. But if you don't get on the right side of change, you're going to be left in a disrupted world order. Sure, there are risks in innovation, but there are risks in not being there. And we think those risks are growing by the day.
There's a couple things a couple dimensions of like the relatively unequal playing field that we've seen historically